SoFi stock has 32% upside according to Wall Street analysts. I have here a analyst price target list of 12 analysts who value SoFi stock in a range between $5 and $10, and the average suggests the value of SoFi stock should be $7.88. Well, that's 32% higher than the current trading price of $5.97. So let's take a look at some of SoFi's financial metrics to see what Wall Street analysts see in SoFi stock that suggests why they think the stock is so undervalued. Starting with SoFi's revenue growth, looking at the 3 years of data that we have, 2020, 21, 22, and a little bit of 23, and we see that revenue has grown robustly over the years, over 50% for several years and 59.77% in its most recent year. So the company is certainly growing very quickly, attracting a lot of new customers, and it offers an industry leading annual percentage yield for customers coming to SoFi, setting up a direct deposit. And so they're getting a lot of customers that are now attracted to those higher interest rates, where banks like Bank of America and JP Morgan, they have some accounts that are yielding just 0% or not not anything at all. So customers are saying, hey, why sit here letting our money get zero when we can move to SoFi and get upwards of 5% on our deposit on our checking account? Looking at SoFi Technologies' net income over the trailing 12 months, I do see an improving trend from January of 2022. Its net income has increased from negative 480 million all the way up to $320 million in losses. Now, it's understandable for companies growing this quickly to have losses on the bottom line. But what I like to see and what I think Wall Street looks for in growth companies is improving margins, right? Making progress towards profitability. And SoFi is certainly showing that with its progress diminishing losses. And in fact, if you look at SoFi's most recent quarterly earnings release, management said that for the full year in 2023, management expects to reach quarterly GAAP net income profitability by the fourth quarter. By the fourth quarter. So this figure here, where the company was losing 320 million, could be positive by the fourth quarter of this year. By the fourth quarter of this year, and onwards of that, it can grow from there if this trend continues. Now, this remains to be seen, but typically when management makes a statement like this, they are reasonably confident that they can reach this target. And many times managements beat these expectations. So they tell you they're going to be profitable, because they're confident they can at least be profitable by the fourth quarter, but they may even become profitable by the third quarter or by the second quarter. Just to be safe, they tell you the fourth quarter and they try to beat those expectations. And that's just kind of what happens on Wall Street sometimes. So I think that Wall Street analysts are seeing this, they're seeing this progress, they're seeing the expectations, and they're trying to get ahead of it and say, hey, this company is making great progress, it's got great revenue growth, it's attracting customers, improving profitability, growing revenue, and they like what they see from this stock, which is suggesting why they see that upside. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And then if you look at SoFi's valuation, looking at its forward price to sales ratio of 2.3, the stock is the cheapest that it's been going back about 15 months. So you're getting this growth stock that's making progress towards profitability, attracting customers, and all the good stuff we just talked about, and you're getting it at the cheapest price it's sold for in the last 15 months. I can understand why Wall Street thinks this stock is undervalued by 32% now. All right, I hope you enjoyed this video. I truly appreciate the fact that you watched it, so thank you so much, and I hope you'll come back and tune in for another one of my videos. Thank you so much for watching.